Hello, everyone, and welcome back to the BSG Wealth Podcast, where we discuss all things related to personal finance, business tax, and wealth management. We had such an overwhelming response to the first episode that we are back and might even make this thing a monthly occurrence or weekly occurrence. We'll see how it goes. But today, as you can see, I'll be joined by Seth Vorhees. Many of you already know Seth. For those who do not, he is a CPA and senior accountant with us at the Barrow Sollenberger Group. Today, we're going to dive into a topic many of our clients have been asking us about. When to turn your side hustle into a full-fledged business. Seth's here to help me through this from his point of view as a certified public accountant. You know, a lot of our clients, maybe we're doing some Facebook marketplace, maybe we're selling some old, collectibles, or we like to buy and sell cars, or, a lot of questions around that. So Seth, just thrilled to have you on, and we're gonna get your take on it.
Brian, I'm so excited to be here with you today. Yeah, like you said, there are a lot of clients that are constantly asking about hey, do I go legit with my side hustle? So I'm excited to be on here today to kind of answer some of those questions and give my perspective and just offer any guidance I can.
Yeah. And, I think we should first clarify maybe what we consider a side hustle, or maybe some examples of a side hustle. Like I consider it, anything like a secondary job, income stream that someone is pursuing in addition to their family's primary source of income.
Yeah, Brian, that's about it. And when I think about a side hustle, I'm thinking of somebody that's manufacturing a unique product or mowing lawns on the side after work and starting to get client contacts from that aspect. Doing retail sales online. We have a lot of people that are selling products on eBay and making some profits off of that in that aspect. Another thing is maybe you have a second property that you're looking at renting, or freelance work in the field that you currently are working in. That's kind of what I think about when I hear the word side hustle.
Exactly. So from a financial perspective, I'm going to talk about some key indicators that might be, time to make the transition from this is kind of a hobby to, hey, maybe I can make this my primary source of income, or maybe I should start worrying about paying taxes, or what I'm going to do with all this income that I'm getting on the side. So, my first indicator that things are getting a little bit serious would definitely be revenue. How much revenue is it generating? Is it enough to maybe support your financial needs? Is it steady income, intermittent, seasonal? Maybe you sell things during one season, but it slows down in the winter. Maybe growth potential, I would say, would be my second thing that I'm looking at. So are there opportunities to scale? Is this something that you're going to be limited by the number of widgets that you can sell, or are there other markets that you haven't even tapped into yet to expand your customer base? Are you holding back time for your business based on your current position? I'm working 40 hours a week in my current job. I only have 10 hours a week to spend on my side hustle, and I'm generating all this income that I think maybe if I tapped into that 40 hours, that this could potentially be a game changer for me and my family. That would be my second indicator that it might be time to take it to the next level. And then fallback plan would definitely be my third. So do you have a fallback plan? What if things don't go exactly the way that in your mind you're thinking it does? Or what if something happens with the economy, geopolitical, all these type of things that we talk about on the financial side? That can happen on a micro scale to your business as well. Let's talk about, I want to talk about business planning just for one second before you even get started. We want to have kind of three plans for your small business before you kick it off to the next level. And the first plan I would say would be your fantasy plan. So let's say everything goes better than expected. Everything kind of falls in line, no customer disputes, no issues with shipping, et cetera, et cetera, et cetera. Then we're going to have kind of the likely plan. which is probably, more or less how it's going to go. And you have some issues, things you didn't think about, startup costs, all these type of things. And then we want to have the disaster plan. So not everything goes the way you think it's going to go. We have a lot of unexpected problems, and we want to make sure that we're covered. We're always talking about an emergency fund with our financial planning clients, and that's kind of where that comes in. What is your fallback plan if the disaster does happen when you do start the new business? But that's why we're kind of here when you're ready to kind of kick things off and take it to the next level. When things are complicated and stakes couldn't be much higher, that's what we're here for, to bounce ideas off of and kind of get you pointed in the right direction. So let's kind of move into your world, talk about tax implications. We can maybe talk about how transition might actually reflect your personal tax situation and what steps that an individual or family might take to minimize your tax liability if you should take it to the next level.
Yeah, Brian, you made a lot of good points there. And the first thing you want to do when you're thinking about taking your side hustle and making it legitimate, is what I'll call it, is the different legal structures of each entity type that you can go with. The first one will be a sole proprietor. And with a sole proprietorship, you can run that underneath your social security number. It is, or an EIN. It is reported on your Schedule C of your individual tax return. And comparatively, there is also a single member LLC that you can also register with an attorney or do yourself. It's entirely up to you. That would be reported on your individual tax return. Now, let's move up to like a partnership. So let's say you have two individuals that want to be in this business together. You can certainly do it that way, and you can set up a partnership that is reported on a separate tax return, though. And what I mean by that is basically there is a separate tax return that's filed each year. And with that, all of the tax passes through to the individual level. So you will receive a K1 is what we call it. And what I like to kind of compare it to is like getting a W-2 from the partnership. Like you get a W-2 from your employer that shows all the income you made. That is what a K1 shows. But with the partnership, you have different structures. You can be limited partners or general partnerships, but that's a conversation for a whole nother day that we can talk about. And then we have what is known as a S Corp. And with the S Corp, that can have multiple shareholders. It can have one, it can have five. But basically it kind of works the same way as the partnership is. It's a pass-through entity that pays tax at the individual level. Each shareholder will receive a K1 at the end of each year to report the income on their individual tax returns. The last one I'd like to talk about is a C Corp. And a C Corp, all of the tax, meaning the tax is calculated off your net profits, is paid at the corporate level. So there is no tax obligation for the shareholders that in the corporation. One of the things with the C Corp that basically the tax rate right now is a little bit higher than the S Corp and all that kind of stuff. But basically that's the kind of different structures you have whenever setting up your entity, the legal structures you have.
Let me ask a question
Yeah.
about the pass through. So you say pass through entity. Does that mean, let's say I'm selling, let's say baseball cards. Let's say I've collected baseball cards for a long time. I want to start selling them. I put them online. I'm making a significant amount of income, and maybe now I want to start buying and selling baseball cards. I'm kind of turning this into a little bit of a business. If I do with the pass through, does that mean all the revenue and all the expenses just pass right through to my personal return and I don't have to file anything separate, right?
No, that's incorrect, Brian. So basically, when I say pass through, I mean there's a separate tax return that's filed. For example, partnership is a 1065, S Corp is 1120S. And basically all of the income that would come from the baseball cards will be reported on the business tax return. All of the deductions would also be reported there. And then you would get the K1 that would show the net profit from that business type. And it would still come through, like, let's say if it's still a side hustle and you're still working full time, you would have your W-2s and your interest and your 1099 dividends and your brokerage statements. And all of that on your normal return would remain the same, except it would add another schedule to your return. That basically it just adds it into your ordinary income that you have on an ordinary basis. And then you pay tax, it gets just added to your taxable income. And that kind of leads me into talking about the tax side of things. So when you're a sole proprietor or single member LLC, like I said, it's reported on a Schedule C. So it's just another page added to your tax return per se. It's another couple pages actually. But since, and if you notice when you're with your employer, you get your pay stubs, you see all those nasty taxes that are taken out throughout the year, your Social Security, your Medicare, your state, and your local. With a sole proprietor, single member LLC, you don't have those withheld throughout on a biweekly basis or monthly basis. So the IRS, they charge a self-employment tax on your income, which is 15.3%.
Ouch.
Yes, it is. It can be a nasty thing. It certainly can. However, if you think about it this way, it is basically 15.3% is the Social Security and Medicare portion of the taxes that are charged on your income. And since you are your own employer as a sole proprietor, single member LLC, you're responsible for 100% of that self-employment tax. If you look at your pay stub now from your ordinary employer, you have Social Security Medicare taxes that equal 7.65% of what you make. So basically, as a sole proprietor, you have to pay the 7.65% as the employee and 7.65% as the employer. So that is where I'm getting the 15.3 at, Brian. And basically, when you look at your tax return after you go through and you're like, oh man, I'm getting charged with 15.3%, the IRS does allow a deduction against your taxable income of the 7.65% because it's giving you credit for being the employer and paying that portion.
Oh, so it's not quite as painful as 15.3 is a big number, but okay, at least they give you the employer portion off of the federal. So that's good.
That is good. And the other thing is when remember I brought up the S Corp a little earlier. The S Corp is a little different entity type, and what it does is basically allows you to pay yourself a wage from your business and deduct it against your business income. And actually the IRS requires you to take a wage at a reasonable salary of what you would pay somebody else that's doing your job to do. But with the S Corp, there are some tax advantages there. Let's say you make $100,000 a year net after all your expenses before you pay yourself. Let's say you pay yourself a $50,000 a year salary, and that means that you would get a W-2 for $50,000 and it would have all those nasty taxes I was talking about earlier, your Social Security, your Medicare, your unemployment, your state and local.
On and on and on.
On and on. I could go on for days about it, but that net profit, so you have your 100, you pay yourself 50. So now what happens to this net 50 that's there? Well, the IRS allows that is not subject to self-employment tax. So basically you're getting out of that 15.3% of tax on that excess 50,000. So that's some of the tax advantages of an S Corp per se. And then we have the partnership. Partnership income is subject to self-employment tax. Partners can pay themselves with guaranteed payments. But at the end of the day, those are still subject to self-employment tax. On the sole proprietorship, that's one thing I missed there. A disadvantage of the single member LLC or sole proprietorship is you can't pay yourself and deduct it. So basically the personal money you're paying yourself for all that time and effort, you are not able to deduct. However, the advantage is it's a much simpler return. It's not a separate cost of having an accountant prepare or doing it yourself type deal. It's all reported on your individual tax return. And that's why we still see a lot of sole props and single member LLCs. Since your tax isn't being off of your withheld from your pay stubs, like I was talking about earlier, the IRS expects self-employed individuals, whether it be partnership, S Corp, sole proprietor, single member LLC, to pay quarterly estimated tax payments. And that is based off of what profit you believe you're going to have at the end of the year that you're going to pay tax on. So basically, the IRS requires you to pay a percentage of that money in quarterly to avoid any interest and penalties that may be charged. And that kind of explains the tax side of things in a nutshell. But let's talk about the tax is kind of the disadvantage, of course,
Yeah,
from anything
yeah.
you
I
do.
I did want to ask you one question. So let's say I was starting my baseball card business, and I kind of want to, as I do want to take this to the next level and start reporting some income. And what would be, this obviously isn't personalized tax advice for anyone out there who happens to have a large baseball card collection. But what would be kind of my easiest step forward to cross the threshold? Like you wouldn't want to go right to a C corp, right? You'd probably what would be kind of the least I guess difficult barrier to entry there? What would be the most logical step forward?
Yeah, that's a good question. So with your baseball card example, I do have to throw out there that even though, let's say you are making some income, right? I can classify that as the IRS classifies that as hobby income.
Mm,
And so basically, if you make revenue from anything you do, the IRS expects you to report it and pay tax on it. The disadvantage, the hobby side of things is you have to claim the income. It's not subject to self-employment tax, but you cannot deduct any business expenses. I just want to throw that out there whenever. So
gotcha.
basically, if you are making revenue from something, we should report it to the IRS. But the easiest barrier of entry, so let's say with clients that I work with, I always say, hey, why don't we start out as a sole proprietorship
Mm.
or a single member LLC? Because basically you're avoiding cost of the professional fees of doing a new tax return. And basically they're registering with the state. And basically I talk to them, I then refer them to an attorney to talk about, hey, should I be a sole proprietor or single member LLC? Because the attorney will help them with the liability aspect of everything.
Oh, okay.
And basically they can register them with the Department of State and all of that. But basically, it doesn't take much to do the sole proprietor route. Basically, that would be the easiest way of entry to start making it more legitimate and being able to write off your business expenses, which goes into a whole nother category.
And I think that is where a lot of people listening, I think a lot of people are going to say, wow, how can I turn this business opportunity? Now you've told us all about the taxes. What are some ways maybe to save a few dollars? I think that was a good segue into maybe talking about business expenses, tax credits, those type of things.
Right. So for the self-employed individual, if you're purchasing, so let's say, for example, with your baseball card collection
Mm.
example, so you're going to have postage, you're going to have eBay fees, you're going to have selling fees off of what you sell. Being self-employed with one of the entities we were talking about earlier allows you to write off anything that's being used in the trade or business. So whether that being the postage, the shipping, the cost of doing your tax return, we can actually start allocating some percentages towards that and write that off as well. But basically, if we switch that over into like a trade industry, like an auto mechanic or somebody like that who's working on cars, we get to write off tools that they're using in the course of business. And if you know, like I do, machinery equipment isn't cheap nowadays.
Right.
So that allows them to write that off. And one of the big things as well that being self-employed, let's say you're driving around for your business all the time and you're keeping track of your business mileage. That's a
Oh,
huge deduction that the IRS allows you to deduct from your business income. Basically, with the standard mileage deduction in 2023, it was 65 and a half cents a mile. So
okay.
think about that. You drive 10,000 miles for your self-employed job and your
Yeah.
business, you get to write off 6,500 of that.
Okay.
And basically being able to you're able to write off, let me think here. We can do you have a home office? If in your job, if in your business, are you using a area of your home that is specifically for office and business use? Well, hey, we get to write off a percentage of all those nasty utility bills and all the property taxes and the mortgage interest that you pay, and write it off against business income. One of the most important things with going self-employed and being able to write off the expenses and record the right amount of income is record keeping. A lot of clients that I work with, they're very good at doing the trade or doing the job, and they want to go out there and that's what they want to spend their time doing. But if we take the time in the beginning and set up a good record keeping function, it makes them being able to see what they're making on a monthly basis, a weekly basis, or even a month or quarterly basis,
Mhm.
and it makes it easier come tax time, for
Yeah, that
sure.
makes a lot of sense. And if I'm just going to go ahead and plug the business here, but if someone does need help with some bookkeeping, I think we do offer that as a service. So let us know. Maybe we can help you turn your side hustle into a business. So anything else, Seth, before I kind of I want to kind of wrap this up, and then I do have a couple questions that I received from clients that I'd like to answer too. So anything else you can think of?
Yeah, I did want to talk about a couple of credits that are out there for
Okay.
self-employed individuals. So basically, one of them being is the qualified business income deduction.
Hmm.
That credit or deduction is basically they take a percentage of your net profit that you have, and they allow you to deduct 20% of that number against your taxable income. So
Okay.
it's an extra deduction that's out there for self-employed individuals. Another one is if you were paying for health insurance out of pocket, there is a thing is basically self-employed health insurance deduction. And these are all above the line deductions that reduce your taxable income. They do not reduce tax, but they reduce your taxable income, meaning what you can pay tax on.
Hmm.
And another one is, which Brian, this is your specialty. There's IRA deductions and retirement saving credits and all of that kind of stuff. So the IRS does give out some benefits for being self-employed. It's just making sure you have the knowledge and you have a relationship with a tax advisor or CPA that can walk you through all of those credits.
Got it. Got it. Yeah, I think that's really good information. And you know, I feel like turning your side hustle into a business. I mean, what could be more exciting? What could be more rewarding? The American dream. Very important that approach it thoughtfully and strategically. Take your time, evaluate your financial situation, consult with professionals like myself and Seth. Make sure that that's kind of it's not that you can't put it back in the bag, but you definitely want to measure twice and cut once with a big decision like that. Um, Entrepreneurship comes with its challenges, with careful planning and perseverance. You can turn your passion into a successful business venture. And I think that we both work for a small business. We've seen the struggles and we've seen the victory. So I think that we we would be happy to support any client in their venture to turn their side business, or at least help you make that decision. So I do have two questions here. I wrote them down. I think the first one's going to be more to you, Seth, and the second one's probably more my speed. But this was from a client who's an automotive technician, is currently working full time at the dealership, considering building a two-bay garage on his property to use as personal storage and starting to offer some automotive services at the home. So kind of dual purpose there. And the question was how to determine what portion of the building is personal and what portion may be used for the future business, kind of current business. And then can my tools at home, so he's already got these tools, can my tools at home and any future tools be a business expense? How does depreciation work? So I got like 5 questions in there. If you need me to reiterate, let me know.
All right, Brian. And a lot of these answers are going to be an it depends type situation. So for this scenario or this question, so the first question was, how can I determine what the business portion of my garage versus my personal portion, and how does that calculation work? So basically you can determine the portion of the building or garage that is business by calculating what square footage in that garage is going to be used strictly for the trade or business.
Hmm.
Once you get that number, so let's say that number is 120 feet, okay? And then let's say you got to give me the total square footage of the two-bay garage, including the business use portion. And let's say that's 480. So I'm using flat numbers here at 25% being used for the trade of business. What we would do is we would allocate 25% of the cost that it takes to keep that two-bay garage up and running and write it off for business use.
Hmm.
So for example, utilities, electric, internet, whatever else you need, cell phone or telephone, landline, that kind of stuff. That's how we go about calculating what can be used in the trade or business.
So
So
pretty straightforward, no tricks about it. Just kind of what portion are you going to use for business? Take that number across the board, and that's how, obviously it depends, but that's generally how you're going to determine what the proportionality there of the write-off. So okay.
exactly, exactly. And then, yeah, so basically, and let's move on to the tool question here.
Mhm.
So yes, if your tools are purchased they're purchased at home, but they're going to be used strictly in the trade or business, yes, we can certainly write off 100% of those tools.
Hmm.
Let's say you buy a piece of machinery or a tool that you know that you're going to use 50% for personal and 50% for business. Well, we would allocate 50% of that being written off in the trade or business. And it's all about, again, about having reasonable arm's length allocation percentages. So if you know that, hey, I'm really only going to use this 20% in the trade or business, be honest and say, hey, I'm going to use it for 20%, and we'll write off 20% of the cost. But yes, and again, that leads me back to keeping good records. If you're recording everything that you're paying, and especially if you have a separate business checking account that you're running all of that information through, we can certainly write off anything that's being used in the trade or business. Now, I do want to iterate that basically, if it was a tool, it has to be purchased in the current year. We can't write off
Okay.
an air compressor you bought 5 years ago.
Okay.
But anything that's that's purchased in the current year, if we can argue that it is being used in the trade or business, we can certainly use that as a deduction for the
Okay.
business.
Okay, and then what was the last part of it here was just overview on depreciation. I know a lot of people are curious. I'm always curious about, I don't know, when can you depreciate something over 2 years or 10 years, or what's kind of the general rule of thumb there?
Right. And this is a big it depends. And I could go on for 2 hours about
Right.
depreciation. Not that anybody wants to hear that. But basically, so let's say I'm thinking of an example in my head. So the automotive technician, right? You buy a lift that costs about 25,000. You're putting into the garage, and that's where that's in your business portion. And the IRS basically requires you to capitalize that asset. It's a tangible asset. You own it. It's costing more than $500 to $2,500 in that range. And what depreciation does is it takes it and you say, okay, how long is this going to last me? What's the life of this piece of equipment? Most of the times it's 5, 7 years. I don't usually use the 10 to 15 unless it's a different for tangible business machinery and equipment. But basically, in a simple terms, you're taking that and expensing it over that 5 or 7 year period. Okay. And current tax laws actually allow you, there's called a Section 179 deduction. It's an election that you make that allows you to write off that purchase in the current year if you would have taxable income up to that amount.
Hmm.
Meaning if you had $25,000 of net profits, you paid $25,000 for the lift. An option would be to write off 25,000 and bring your taxable income down to zero. What the Section 179 deduction can't do is create a loss. Meaning, so if you had a $10,000 profit, we can't write off 25 and take a $15,000 loss.
Gotcha.
The other one, and there's much more that you can do with depreciation, but the other big one that clients are taking advantage of is called the special depreciation allowance or bonus depreciation. Now, and that is starting to phase out a little bit, the IRS guidelines, but basically in 2023, it allows you to write off 80%. That was in 2023, 80% of what that asset cost you in the current tax year. And in 2024, that's going to be 60%.
Okay.
And there hasn't been any provisions made to that just yet. But so basically, and that does allow a loss. You can write that off and create a loss to reduce your other taxable income. But again, with each asset that's purchased, each trade or industry that you're in, it depends on how we can depreciate. And I seriously do encourage you to give me a call or give
Yeah.
your tax professional a call if you have any questions regarding this and what it might do and how it might impact your taxes.
Yeah, I was going to say, before you make any big decisions with your hobby or small business, yeah, please give us a call and talk to Seth or one of the other CPAs, and they'll get you set straight. All right, I think that about covers it. Hopefully, let me see. That was Brad, if you're watching, that was for you, buddy. So we'll just move on to the next one. Um, this is considering starting my own independent marketing consulting firm and oh, planning to quit current W-2 position, will not be able to contribute to the current plan. And what options do I have as a small business owner to start my own retirement plan? So yeah, that is right down my alley. So very simple. If you're just getting started, maybe you just want to open an IRA. While not specific to small businesses, can be used for self-employed individuals to save some money for retirement. You get the tax deferred growth and on the contributions, and then you can also do Roth IRA contributions, which it's our favorite. They grow tax-free, and when you take them out, it's tax-free as well. So we like Roth IRAs. I want to say $7,000 under 50 years old and $8,000 over 50. So a little bit of money there you can kind of put away and save for your retirement. Now, if you're looking for a little bit more, say your side hustle is really booming in the first year and you need a little bit more deferral, you can always do a simple IRA. Same as an IRA, but savings incentive match plan for employees, individual retirement account, small businesses with less than 100 employees. So I'm guessing if you're just getting started, that's probably going to be you. Very easy to implement. Does not take a lot of time, not very expensive. We can set them up in a couple weeks, and it's really it's a great way to save for your retirement. It's over $16,000 you can put away in there, and you can also do the matching provision, which up to 3% or a 2% non-elective match in the simple. So if you're just getting started, but you need to defer a little bit more than you could in an IRA, I'd maybe open a simple. And then you have the SEP IRA, which I've got several of those for small business owners that we work with. Simplified employee pension. Specifically designed for self-employed individuals and business owners. The contributions is a big difference to the SEP IRA, only made by the employer. If you have a great year, you can choose to make that contribution. If you don't have a great year, it's not mandatory, so it's kind of flexible. Now, employees do not contribute to SEP IRAs. So if you are going to open a SEP IRA and you have employees, I would definitely take that into consideration. Whatever you're putting into your SEP IRA, you're going to have to it's uniform to all employees. So you're going to have to also contribute that to the employee's account as well. Just make a consideration on that. And then 401ks. Everyone knows what a 401k is. A little bit more sophisticated, a little bit more expense in setting it up. Once you get it's kind of out of the guardrails of where we wanted to stay today. But if your business is really getting going and you need to make those maximum, you want to defer as much as you can, and you want to write off your employees, contribute your matching, and that might be something to look into as well. So the 401k, but anytime if you are thinking about setting up a small business and interested in a retirement plan, certainly give us a call and we'll definitely point you in the right direction. I think that is it, Seth. We got our 2 questions there. I'm gonna say I think we're gonna keep this going maybe once a month or so. I'll try to keep a fresh face on here, and if anyone has any questions or they want us to answer any questions, I'm going to keep the Q&A going as well. Doesn't have to be related to the topic. Just email your questions to Brian, BRIAN, at bsgwealth.com, and I will do my best to answer your questions here on the podcast. So I think that's it. Seth, anything else?
No, I appreciate you having me on here, Brian, and I appreciate hearing any questions that the clients may have. And here at Beresall Group, that's what we thrive on, is working with small businesses and seeing sustained growth and success. And we want to grow with you. So reach out with any questions, and I look forward to hearing from you.
All right. Well, I think that about wraps it up. Everybody, thanks for watching and stay prosperous.
The BSG Wealth Podcast is hosted by Brian Barrows. The Barrows-Sollenberger Group and Barrows-Trossel Advisors does not offer or intend to offer personalized financial advice through the BSG Wealth Podcast. The information provided is for informational purposes only and does not constitute tax, accounting, investing, legal, or financial advice. The podcast is produced by Brian Barrows, a registered investment advisor with Barrows-Trossel Advisors. Securities are offered through a Vantax investment service, member FINRA, SIPC.